Good afternoon and welcome once again to Digital Look TV from London. Joining us today is Zak Mir, editor at Spreadbet magazine. Zak, thank you very much for joining us.
Thank you.
Okay. We're going to run Mr. Mir through our own little particular stress test this afternoon. Are you ready, Zak?
I am, yes.
Okay, first question. 140 in the euro dollar, red line in the sand for the ECB or not? Are they afraid to point this out to traders?
I think if you're going to play it smart with the currency markets, you don't try and reveal what your wishes are regarding where you want your currency to be. The only time that's actually worked in the recent past was with ECB President Draghi suggesting that traders should not be short of the euro. But that was a panic time. I think at the moment we're really trying to get the eurozone out of recession, and the last thing that it needs is for the euro to get too strong. I'm not quite sure how long it's going to be sort of capped towards 140. It's probably more of an issue as far as dollar weakness than necessarily euro strength. But obviously, if the euro is coming out of eurozone is coming out of recession, that is going to strengthen a currency.
Okay, cable. Where do we see it going in the next 2 or 3 weeks, for example?
I think that the surprise at the moment is probably that it's hanging around the $1.60 mark. From a charting perspective, you probably would have thought it would just have shot through $1.60 towards 165, 170 even by the end of the year, and that might still happen. But at the moment, we're pausing. Got a bit of dollar strength coming in, maybe after the FOMC for this month, and so it's a little bit of a consolidation. But it's tough to see again with an economy with the economic outlook backing it. It's difficult to see how the sterling can be that weak.
Okay.
Put it that way.
Cable moves up to 165. Bank of England. Should we expect a reaction or not?
Well, I think they boxed themselves into a corner. The forward guidance to me is a foolish guidance, and it's going to only end in tears in terms of them having to raise rates earlier than they would have wanted to. That's the only. There's no happy ending on that strategy. It was a bad move. You're revealing your cards. You're revealing your hand in the way that the ECB is not revealing its hand. So it's the opposite approach.
Okay. Last week we had the FOMC policy statement. Miscommunication on the part of the U.S. Central Bank, or complacency on the part of traders?
I think it's a bit of a non-event. I think that we were in this sort of lame duck period in terms of Bernanke going out and Yellen coming in. Everybody has already assumed that nothing is going to happen. Well, I don't think Bernanke would end tapering before Yellen managed to get into the job. So the tapering continues. It's a situation where the dollar cannot get too strong, I think, and really, whether the minutes of the FOMC meeting are, one way or the other, their hands are essentially tied.
Okay. Equity markets, they've gone a little bit ahead of themselves, or not?
I think they've gone ahead of themselves in terms of the US, in the sense that, you've got record levels there for the S&P and the Dow, and really, the underlying economy or the outlook, there's plenty of uncertainty there, doesn't justify the sort of euphoria that we've seen there. The explanation that I would have is that it's a massive bear squeeze rather than a bubble, and that traders went short on the debt ceiling crisis and have just been squeezed to death.
Okay. FTSE 100, up or down this year?
My view is basically I was probably more bullish than many in the market when it was around 6,300, 6,400 at the start of the autumn. I thought it was a bear trap below the 200-day moving average. It turned out to be that. It was the same sort of maneuver that we saw in June. After the June bear trap, the market went up 300 points, and we've seen about the same 300, 400 points now. So from a charting perspective, it's a sort of understandable move. Disappointing that hasn't actually just shot through 68.75, which was the high of the high of the year. But it's still early days in terms of a year-end rally or how that would pan out.
Okay, where do you see it heading towards the end of the year?
I'm looking for about 7,200 as the technical target there. There's a price channel on the FTSE there. So 7,200 is the December the 31st destination. You normally see a a run up until that time.
Okay, again, FTSE 100 next year, up or down? Where?
I think if we get, after 14 years, it's probably overdue that we've got a break to the upside. I think that this is probably this is probably going to be the time where we do go over the top. And if we get that 7,000 handle on the FTSE by the end of this year, I would be looking for a decent 10% move over 10%. The following year. I think that's not difficult.
Okay, individual stocks. A stock you like a lot.
Well, I think a stock I like a lot, probably from a technical perspective, is BP, which sort of gapped up through its 200-day moving average.
A bear trap?
Well, yes, it's a bear trap in the sense that that's the effect on traders, that they would have been short maybe ahead of the update from the group, which announced a dividend increase, which probably surprised people by its sort of generosity. And I think that could squeeze much higher. Obviously, that ties in with my FTSE 7,000 or 7,200 by the end of the year. So that's why I mentioned BP as a sort of favorite play there.
A stock you hate?
A stock that I would hate to be involved in probably is Aggreko, which is the temporary power group. Any situation where you have the quandary as to whether a company is going X growth, which is what you have there is always a nasty position to be in.
Definitely. Okay. UK housing, bubble or not?
Definite. I would say it's a definite bubble in London. The trickle down to the rest of the country actually may be in a way more dangerous. Maybe in London, maybe London is being correctly re-rated as a international city-state situation, the new Monaco or that sort of thing. But the rest of the country, probably, you probably have property prices there totally out of line with people's affordability, and also as well in terms of the outlook on interest rates, which I think if they go up even a tiny bit, people are going to get squeezed very hard.
Okay, Eurozone, the latest CPI numbers, 0.7% year on year, 0.7%. That's quite low. Should the ECB cut rates? Yes or no?
I think that I've liked the ECB's policy in general because it's tended to be less is more, much compared to the US or the UK. I've liked the whole approach they've done there. They've averted the crisis with the euro. It's still here, and it's going to remain here for a long time. The way it looks, so I think they've done very well, and I think they'll probably go for a leave things alone policy as they have at the moment. I don't think that when rates are sort of under 1% or they're just such low figures, the odd tweak here and there doesn't really make a difference. It doesn't get passed on to the customer or in any meaningful way. Loans are dirt cheap, but we still have massive unemployment and those sorts of aspects. So it won't make any difference. I would leave it alone. Happy with the CPI being low.
Okay, U.S. government shutdown. That seems to be resolved, or come spring, will it turn out that it has not been resolved?
I think it's the law of diminishing returns in terms of how much the market is shocked by these things. People do go short of indices on that basis, but if you notice, this time as compared to the turn of the year was not so dramatic, and you know that there's only one sort of path that the politicians. It's a game of chicken, it's a game of bluff, and it's all in the end it's actually rather farcical. So I don't think there's going to be, even if we come around to the spring again and another type of fiasco on Capitol Hill, I don't think it's really a market issue. Okay. That's probably have a unique view on that. I think it is literally politicians playing games.
Cheap politics.
Yeah.
Okay. Last question. China, Japan, macroeconomic accidents waiting to happen or not?
I think that we're probably with China forced to go along with the Chinese line and to take the view that the last GDP figures were sort of decent, nearly 8%, and that they are able to regulate and control their economy in a command fashion, and really we've got to go with that. There has been an emerging market scare, seems to have sort of died away a bit. And so I would with China, I would say more of business as usual. Just I mean, I'm happy with that.
Okay.
It seems to be stable. Let's say stability is the main thing.
Thank goodness. Okay. Japan?
Japan, we've got the Abenomics revolution going on. I think it's a bit stalled. I think we're looking probably for sort of the second round of getting dollar-yen through 100 and staying through 100, having that feed through to Chinese companies, Chinese exporters. But at the moment, we seem to be sort of, it's a sort of a bit of a no man's land.
Okay.
So we'd like to see, I mean, dollar-yen is on its 200-day moving average. That's not any great achievement in terms of weakening the yen or doing anything which would help the economy there. So a bit of a sort of a small sort of style and substance, I think, on that issue.
I heard earlier a great market analyst telling me that if Abenomics was really working, dollar yen ought to be at 115, 120. Have you heard that?
I think that I would be in total agreement with that. I'd be going for that too. I think that
it was you who said
point,
it.
The point is very sensible thing to say. That the point would be really that given the momentum that there was this time last year in terms of dollar yen and how high it would go, you would have thought by now it would have been through 110, 115. The fact that it's at 97, 98 is a bit pedestrian, given the sort of the hype and the hope. The hype and the hope that there was for that. So, then you sort of think, is this just another dead cat bounce in the whole post-1990s Japan situation? So it becomes like that, another false dawn.
Okay. Zak Mir, editor, Spreadbet Magazine. Thank you very much for joining us. Thank you very much for your time. Hope to see you again.
Thank you.
And that's all from us here at Digital Look TV. Thank you for joining us. Until next time.